I'm Tyler Laundon, the Chief Analyst of Cabot Small Cap Confidential and Cabot Early Opportunities, here with your Cabot Weekly Review. It is Friday, July 26th, and we are coming up on 10:45 a.m. Eastern Time. As you can see, the S&P 500 is up modestly on the day, but let's back up a little bit. The big news of the week really was the Wednesday sell-off. This is when we got more emails about what was going on in the market. We saw the S&P 500 index suffer its biggest one-day pullback since December of 2022, and you can see that right here. The index closed below its 50-day moving average line and was a little weak yesterday as well on Thursday. The rotation was the most severe among the tech stocks, so the NASDAQ 100 was down more than 3.5% on Wednesday. That was its worst showing since October of 2022, and the Mag 7 was down over 5.5%. Now, in terms of what was driving the selling, you could kind of blame it on either Google or Tesla or both. Both of those companies reported on Tuesday and were down pretty significantly on Wednesday. But to be fair, there's been a lot of griping about a weak consumer lately. A lot of consumer stocks just don't look good at all. And a lot of scrutiny about AI stocks and that whole theme, and just maybe too much bullishness. So it might have just been that the market got ahead of itself, needed a bit of a sell-off to kind of reset. If we look at the macro events of the week, so yesterday we got second quarter GDP. It was better than expected at 2.8% versus expectations of 1.9%. And then this morning, PCE inflation reading comes in for June about as expected, so hopefully helping to confirm the disinflation trend for the Fed, which is set hopefully to cut in September, and they'll be out next week with the next FOMC meeting. Now, let's switch over to small cap stocks. There's been a lot of talk lately about small cap outperformance. So I'll pull up a chart of the S&P 600 small cap index here. And as you can see right here, it was on July 11th, which was when that CPI report came out. The small caps really took off, outperformed for 4 days in a row. And then they've been kind of hanging out around this 1400 level in the S&P 600. Over the last week, so talking Friday through yesterday's close, so Thursday's close, the small cap index is up 1.5%. Doesn't maybe sound all that meaningful until you look at the S&P 500, which was down 1.8% over that same time frame. So over the last week, small caps have outperformed by 3.3%. Maybe more importantly, I broke this down by sector and I looked at it, and small caps have outperformed across all sectors, including technology. So now, speaking of relative performance, it really has been a long time since small cap stocks have outperformed on like a multi-quarter or multi-year basis. You have to go back to the early 2000s to find that. Now, I'm not saying the small cap stocks haven't outperformed for shorter periods of time, since they certainly have. But, to find those periods that we kind of associate small cap stocks with as leading the market, it has been a long, long time. Now, again, talking about that CPI report, why was that so important? Well, it increased the odds of a rate cut in September, which should have an outsized benefit on small cap stocks, given that they have a much higher rate of exposure to floating rate debt, which we all know is pretty expensive at the moment. So around 40% of the S&P 600 has floating rate debt versus closer to just 5% for the S&P 500 index. There was probably also a boost from Trump's surge in the polls and speculation that there would be another Trump presidency, which could mean more pressure on China, potentially worse for large cap companies than small cap stocks, which are more domestically focused, and also maybe a greater crackdown on large cap tech stocks, which again could open the door for more rotation to small cap stocks. Now, kind of interestingly, since Biden has dropped out of the race and Harris has stepped in, and as she has risen in the polls, small cap strength has continued. So it kind of makes me think that Trump trade maybe wasn't all that important for small cap stocks, or maybe the cat has been let out of the bag and there's been enough rotation momentum to get people focused again on small cap stocks. And maybe that could be one of the reasons that the outperformance could persist as this story gets to be better known. They're trading at a discount, et cetera, et cetera. Now, granted, small cap earnings have dramatically lagged that of large cap stocks for a while. It's really hard to compete with those earnings from the Mag 7 stocks. So there's good reasons why small cap stocks have trailed lately. But again, there are also developing reasons why they could do better moving forward. I think probably the biggest risk to small caps like dramatically out or underperforming would be a recession. But again, we just reviewed those second quarter GDP results. So at the moment, that doesn't seem to be a big. Now let's move into some individual small cap stocks. So one of the developments this week was in the advertising technology market when Google announced it would no longer be deprecating cookies. So in plain English, that means that Google's Chrome browser will continue to use third-party cookies to track user activities, but it's going to release a new user experience that offers greater control over data and privacy. So essentially, it sounds like users will be able to opt out. Now, the takeaway from that was that it could be positive for a number of AdTech stocks since it creates more certainty in what has been a relatively uncertain market and kind of shifty over the last couple of years. So I did some work on this, and kind of interestingly, so a couple of the larger players in this market are the Trade Desk, ticker symbol TTD, which we have here. As you can see, that's down over the last week. And then also AppLovin, ticker symbol APP, which didn't really have the best week either. But in contrast, a number of small cap ad tech companies did pretty well. So those companies are PubMatic, CRTO, and ZETA, and we'll talk about those. So we'll start off with PubMatic. The ticker symbol here is PUBM, and market cap of just over 1 billion. So PubMatic specializes in online advertising for digital publishing and advertising. Report is out in 13 days, so that's, I think, August 8th. And analysts are looking for revenue to grow by about 13%. PubMatic, if you look at the quarterly numbers, it's not profitable on a quarterly basis, but the fourth quarter is usually very good, so they churn out a profit on an annual basis, and this year earnings should be up by about 47% to 23 cents a share. So check out PubMatic if you're interested. Again, these aren't like formal recommendations, but I think it's an interesting space given what is developing. CRTO is a French company. Ticker symbol is CRTO. Market cap of 2.5 billion. And they kind of operate in this intersection of e-commerce, digital marketing, and media monetization. It gets around 10% of its business from retargeting. And I think that's really the area of the business that could benefit from this change that Google is doing. Revenue is seen up around 9% this year, and the company is profitable. Earnings are expected to grow by about 20% to $3.79, and earnings will be out next Thursday, so that's on August 1st. And lastly, we have ZETA. Ticker symbol is ZETA. Market cap of 4.7 billion, and it is a marketing software company. It has a platform that provides consumer intelligence and marketing automation to enterprises. So essentially, it helps marketers better understand their consumer and target them with ads that hopefully consumers will identify with. We have earnings coming out on July 31st, so in 5 days. Revenue expected to grow by 25%, while earnings losses should drop by about 70% this year to a loss of around 38 cents per share. And ZETA is on track to generate a profit next year. So again, a few details there. Those are three companies to watch in the ad tech space, which appears to be shifting because of some of the changes that Google is making with its third-party tracking technology. Now, looking forward to next week, the big event is going to be the FOMC meeting, which is going to wrap up next Wednesday, and Fed Chair Jerome Powell will have his press conference after. Current odds of a rate cut are only about 6% for next week, so don't get your hopes up. But the odds for September are looking pretty good at 88% probability. So keep your fingers crossed for that, and hope you have a nice weekend. Talk to you soon. Bye.